Welcome to this week's episode. Today we are going to be talking in more detail about reviewing your needs, goals and investments. So first we need to take the time to think about what you really want from your investments. Knowing yourself, your needs, financial and lifestyle goals and your appetite for risk is a very good start. It's important to know why you are investing. The first step is to consider your financial situation and your reasons for investing. For example, you might be looking for a way to achieve higher returns than you are currently on cash. You might be looking to put money aside to help pay for a specific goal, such as your children's or grandchildren's education or their future wedding. Or you might be planning for your retirement. Determining your reasons for investing now will help you work out your investment objectives and influence how your investments are managed in the future. If you're investing with a specific financial and lifestyle goal in mind, you've probably got a date in mind too. If you've got a few goals, some may be further away in time than others. So you'll need to have different strategies for the different investments and timescales. Investments rise and fall in value, so it's sensible to use cash savings for your short-term goals and investments for your longer-term goals. And be aware that most investments need at least a 5-year commitment. But there are other options if you don't want to invest for this long, such as cash savings. Be aware that most investments need at least a 5-year commitment. But there are other options if you don't want to invest for this long. And it's as simple as using cash savings accounts. Committing your money for at least 5 years opens up a selection of investments that might suit you. Your investments make up your portfolio and, if appropriate, should contain a mix of investing in shares, funds, bonds, and other assets, or a mixture of these, which are carefully selected and monitored for performance. So let's say you start investing for your retirement when you're fairly young. You might have 25 or 35 years before you need to start drawing money from your investments. With time on your side, you might consider riskier funds that can offer the chance of bigger returns in exchange for an increased risk of losing your money. As you approach retirement, you might sell off some of those riskier investments and move to safer options, with the aim of protecting your investments and their returns. How much time you have will make a big impact on creating your investment portfolio. And as a general rule, the longer you hold investments, the better the chance they'll outperform cash. But there's never ever going to be a guarantee of this. Once you're happy and you have set financial and lifestyle goals, the next step is to get your investment portfolio in place. You can do this yourself or through a financial advisor, and they can help you identify the right type of investment options that's suitable for you. Holding a balanced, diversified portfolio with a mix of investments will help protect it from the ups and downs of the markets, and different types of investments perform well under different economic conditions. By diversifying your portfolio, you can aim to make these differences in performance work for you. Diversifying your portfolio in a few different ways through funds that invest across different types of investments, different countries and markets, different types of industries and companies. A diversified portfolio is likely to include a wide mix of investment types, markets and industries. And how much you invest in each is called your asset allocation. We'll delve into that in a bit more detail later. As well as deciding what to invest in, think about how you'll hold your investments. Some types of tax-efficient accounts normally allow you to keep more of the returns you make and less in tax. It's always worth thinking about whether you're making the most of your tax allowances too. You'll also need to bear in mind that these tax rules can change at any time and often do, and the value of any particular tax treatment to you will depend on your individual circumstances. Periodically check in to see if your portfolio aligns with your goals is also a very important aspect of investing. Let's sort of delve into some of the aspects of your portfolio that you may want to check on an annual basis. The first is changes in your financial goals. Has something happened in your life that caused for a fundamental change to your financial life plan? Maybe a change in circumstances, or a change in the time horizon, or the amount of risk that you are comfortable in taking has changed. If so, it's important to take a hard look at your portfolio to determine whether it's still aligned with your revised financial goals. Asset allocation. An important part of investing is setting an asset allocation. An important part of investment planning is setting an asset allocation that you feel comfortable with. Although your portfolio may have been in line with your desired asset allocation at the beginning of the year, depending on the performance of your portfolio, your asset allocation may have changed over the period. And if your actual allocations are outside of your targets or your criteria, then perhaps it's time to readjust your portfolio to get it back in line with your original asset allocation targets. Again, we touch on asset allocation in a bit more detail later. Diversification is another. Along with a portfolio with a proper asset class balance, you will want to ensure that you are properly diversified inside each asset class. And when you start investing, or even if you're a experienced or sophisticated investor, one of the most important tools available is diversification. Whether the market is bullish or bearish, maintaining a diversified portfolio is essential to any long-term investment strategy. Diversification allows an investor to spread risk among different kinds of investments called asset classes. And this will potentially improve investment returns. This helps reduce the risk of your overall investments in your portfolio and also underperforming or losing money. With some careful investment planning and an understanding of how various asset classes work, together with a properly diversified portfolio, will provide investors with an effective tool for reducing risk and volatility without necessarily giving up returns. If you have a lot of cash, maybe more than 6 months worth of living expenses, you might consider putting some of that excess into investments like shares and fixed interest securities, especially if you're looking to invest your money for at least 5 years and are unlikely to require access to your capital during that time. And if you're heavily invested in a single company shares, perhaps your employers, for example, then start looking for ways to add diversification. I've seen this lots of times in different sectors, the banking sector being a perfect example, when lots of employees saved shares through the company, and obviously that sector went into major difficulties and their shares plummeted. So that's a good or a great example of why you should diversify from single company shares. There are also many opportunities for diversification, even with a single kind of investment. For example, with shares, you could spread your investments between large and small companies, the UK and overseas markets, and also different sectors. Could be industrial, financial, oil, etc. Diversification within each asset class is the key to a successful and balanced portfolio. You need to find assets that work well with each other. True diversification means having your money in as many different sectors of the economy as possible. Look at whether there are certain aspects of your portfolio that needs rebalancing. You may also want to consider selling to help offset capital gains you might take throughout the year. So remember, a total wealth solution has no value unless it is properly implemented through an appropriate investment strategy. And if you've got sufficient amount of money in your cash savings, as I've mentioned before, enough to cover at least 6 months. And if you want to see your money grow over the long term, then you should consider investing some of that. Investing is a lifelong process, and the sooner you start, the better off you may be in the long run, regardless of your financial stage of life that you're in at the moment. You will need to consider what your investment objectives are, how long you have to pursue each objective, and how comfortable you are with risk. You also need to consider your current finances and future goals. The right savings or investments for you will depend on how comfortable you are on taking risks, because all investments have an element of risk involved. And that can be on your current finances as well as your future goals. Investing is different to simply saving money, as both your potential returns and losses are greater. So if you're retiring in the next 1 or 2 years, for example, it might not be the right time to put all of your savings into a high risk investment. You will be better off choosing something like a cash account or bonds that will protect the bulk of your money, or putting just a small amount into a more growth focused option such as shares. You may be a few months away from putting down a deposit on your first property purchase. In this case, you might be considering cash or term deposits. You might also choose a conservative investment that keeps your savings safe in the short term. On the other hand, if you have just recently started work and saving, you might be happy to invest a larger sum of your money into a higher risk investment with higher potential returns, knowing you won't need access in the immediate future for that money. Then there's different types of investment options. And if appropriate, you should consider a range of different investment options. A diverse portfolio can help protect your wealth from market corrections, for example. And there are 4 types of investments, also called asset classes, each with their own benefits and risk. And they include shares, where investors buy a stake in a company, cash, where people save into bank or building site accounts, and property, where investors invest in a physical building, whether it be commercial or residential. And there's also fixed interest securities, also called bonds. In essence, investors loan their money to a company or government, such as gilts. And when we look at investments, there are different types of investments. There are defensive investments that focus on generating regular income as opposed to growing in value over time. The 2 most common types of defensive investments are cash and fixed interest. Then there are growth investments that aim to increase the value over time, as well as potentially paying out an income, because their prices can rise and fall significantly. So growth investments may deliver higher returns than defensive investments. However, you also have a stronger chance of losing your money. The 2 most common types of growth investments are shares and property. And although they have historically delivered better returns than other assets, shares are considered one of the riskier types of investments. Let's look at returns. So returns are the profits that you earn on your investments. And depending on where you put your money, it will be paid in a number of different ways. Dividends, for example, paid from shares. Rent is paid from property. And interest from cash and fixed interest securities. The difference between the price you pay and the price you sell for makes up your capital gains or losses. Now you need to look at or understand investment risk. So if you want to plan for your financial future, it helps to understand risk. If you understand the risk associated with investing and you know how much risk you are comfortable in taking, you can make informed decisions and improve your chances of achieving your goals. Risk is the possibility of losing some or all of your original investment. Often higher risk investments offer the chance of greater returns, but there's also more chance of losing money. Risk means different things to different people. How you feel about it depends on your individual circumstances and even your personality. Your investment goals and timescales will also influence how much risk you're willing to take. What you come out with is your risk profile. None of us like taking risks without savings, but the reality is there's no such thing as a no risk investment. You are always taking on some risk when you invest, but the amount varies between different types of investments. As a general rule, the more risk you are prepared to take, the greater returns or losses you could stand to make. Risk varies from the different types of investments. For example, funds that hold bonds tend to be less risky than those that hold shares, but there are always exceptions. Money you place in secure deposits such as savings accounts risk losing money in real terms, your buying power. Money you place in secure deposits such as savings accounts risk losing value in real terms, which is your buying power over time. This is because the interest rate paid won't always keep up with the rising prices or inflation. Stock market investments might beat inflation and interest rates over time, but you run the risk the prices might be low at the time that you need to sell. This could result in a poor return, or if prices are lower than when you bought, losing money. You can't escape risk completely, but you can manage it by investing for the long term in a range of different things, which is called diversification. I've repeated this a number of times, but it's such an important point. You can also look at paying more into your investments on a regular basis rather than all in one go. This can help smooth out the highs and the lows and cut the risk of making big losses. Let's also consider the risk involved, and there's a few of them. The first one is capital risk. Your investments can go down in value and you may not get back what you invested. Investing in the stock market is normally through shares, which is equities, either directly or via a fund. The stock market will fluctuate in value every day, sometimes by very large amounts. And we saw that with the onset of COVID, when the markets dipped dramatically. So you could lose some or all of your money depending on the company or companies that you have bought. Other assets such as property and bonds can also fall in value. So they're not completely safe either. Inflation risk. The purchasing power of your savings declines. Even if your investment increases in value, you may not be making money in real terms if the things that you want to buy with the money have increased in price faster than your investments. So cash deposit with low returns may expose you to inflation risk. Then there's credit risk. Credit risk is the risk of not achieving a financial reward due to a borrower's failure to repay a loan or otherwise meet a contractual obligation. Credit risk is closely tied to the potential return on that investment. The most notable being that the yields on bonds correlate strongly to their perceived credit risk. So in other words, the higher the yields, the higher potential risk. There's also liquidity risk, where you are unable to access your money when you want to. Liquidity can be a real risk if you hold assets such as property directly, and also in the bond market, where the pool of people who want to buy and sell bonds can dry up. And what about currency risk? You lose money due to fluctuating exchange rates. And lastly, there's interest rate risk. So changes to interest rates affect your returns on savings and investments. That's it for this week's episode. Join me next week where we discuss a series of topics that will help you to have a new start to your finances. And as always, don't forget to drop me a message for topics that you want covered next time.